Well. Welcome to podcast number 4. My name is Jason Watson, Watson CPA Group, alongside Amanda Rowles and Joseph Bassett as well.
Hello.
Amanda, what do you do for us?
I am part of the business development team.
Ooh, that sounds exciting.
It does.
And Joseph, what is it you say you do here?
I see myself as a tax professional, but I'm also part of the business development team.
And we see you as a tax professional as well.
Oh, great.
So anyway, well, thank you everybody for joining us. Today we've kind of gone through entity considerations for beginning your business, benefits of S-Corp election, the S-Corp election itself, late S-Corp elections, blah, 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 right? So here we are. We have our S-Corp. Like King George says in Hamilton, what comes next?
What comes next?
You're on your own. Awesome. Wow. All right. Sorry. Bad Hamilton humor. Operating your S-Corp. Again, Jason Watson, Watson CPA Group. What we're going to discuss today is some tax projections and planning, how all that works, our PBRs, which are not Pabst Blue Ribbon. I grew up in Wisconsin, no thank you. But we do call PBRs around here periodic business reviews, okay, and our unlimited consultation that goes along with that. And then we can also talk about tax returns in the process for doing our tax returns for our S Corporation. And then we'll also discuss the S Corp calendar in general. So I got a lot of props for those viewers out there. For those listeners, you're just going to have to trust the paper that I'm reading from.
But you'll hear the shuffling.
But you hear the shuffling,
We'll
exactly.
paint a picture.
All right. Well, Joseph, tell me a little bit about, tax projections, planning, how we do it, how we look at it, why we look at it those ways.
Right. So the tax projections and plannings, we kind of take a collaborative approach to it, obviously, because when you're a subscription client with us, your losses are going to be shared with us, and your successes are also going to be shared with us, hopefully. So the tax planning, the approach we do is we'll get your data, 2 to 3 times a year, and we do these mock tax returns that kind of calculate your overall tax liability. And in order to do that, we have to get a lot of information from you. So we need to know what your business is going to do for the year for net income. We need to know any outside income, if you got W-2, if you got a side job, if you got a little Schedule C that you also have. And then we kind of compile all of that into one big number to compute your overall tax liability. And it's just really nice, especially with the multiple sources of income. Because if you're out in the real world and you have 2 W-2 jobs, let's say you work for Apple and Google, lucky you. It's like Apple and Google aren't going to talk to each other. They're not going to be like, hey, Joey withheld $500 this week. And then Google's like, okay, cool. We'll dial back his withholding. So with us, you kind of get that really high quality planning to kind of take out a lot of the surprises when it comes to your tax payments.
Yeah, I'm glad you mentioned the 2 income situation, because that is a big deal.
Right.
It's a big deal, like you said, because 2 companies don't understand what the other company is withholding, what the other income source is. I mean, a great example is, let's say we have a business owner who makes $100,000 and his or her spouse makes $20,000. That $20,000 income, even if you were to have 0 for allowances, which would be the maximum, which would allow for the maximum withholdings, it still will not withhold enough, because the payroll tables for the $20,000 job can't see that the other chunk of the household makes 100.
Right.
They can only make assumptions. So we take all those assumptions out. We say, fine, okay, we have 20,000, we have 100,000, like you were saying before, we have some rental income, maybe some pension income. We have all these multiple income sources which might be withholding at the correct amount individually. When collectively dumped into a tax return, it blows up. Hopefully the sound effects came through okay.
That was a great sound effect.
Yeah, we don't have a fancy computer for sound effects. We got to make them up
We
ourselves.
just got Jason.
We got to get
anyway,
soundboard.
So we want to, we don't mind telling you bad news, but we certainly don't like surprises, right? So as Joseph said, we're going to do some mock tax returns. Now, guys, these aren't like spreadsheets. I mean, they're actual tax returns. We call them mock because, well, they're not being filed.
Right.
They're fake until that data gets finalized. But it's really nice because we, again, show all those income sources. We go through your deductions, your children, all those normal things, and we end up with a tax obligation. And then from there, what do we do with that, Joseph?
So yeah, once we kind of calculate that tax obligation, the second step is going to be making sure you pay into it and making sure you pay enough. And kind of the approach that we use is tax neutrality. So what that looks like is $1,000 refund from the federal return and then $500 from the state. And we still leave that buffer just in case there's any surprises that maybe we miss, because as mentioned before, surprises are typically bad when it comes to income tax, but if you get a good surprise when it comes to income tax, lucky you. But that's kind of how the second part works. And, throughout the quarters, we'll send you those cash needs. And that's just going to be us outlining how much you're going to have to withhold in order to meet your obligation.
Yep, exactly. So we're going to, thanks for that. That was great. So we're going to compute your tax obligation. And then we're going to say, how do you want to pay this? Do you want to pay this through payroll or estimated tax payments or both? And we would prefer just to do it through payroll because it's easy, right? Mm-hmm. So let's say you are an S Corp shareholder, you're paying yourself that reasonable salary, and we'll have a whole podcast on a reasonable salary. So for now,
Coming soon.
please bear with us, and let's just gloss over the fact that I am saying a reasonable salary and moving on from it. So we've determined a reasonable salary. What's cool about processing your own payroll is, or if you have us do it, is that we can override those withholdings, right? You process a $10,000 check, the payroll tables are going to say, okay, and they're going to run through some statistical analysis of what this income projects to be with these allowances, all that stuff, and they're going to figure out a federal income tax withholding, and same for the state. The downside is, again, it can't see the overall household income, and it can't see the overall household tax obligation. So we told you, hey, you need to have X amount withheld from your check over the course of the year to land on tax neutrality. And so that's the benefit of doing payroll yourself, manually overriding those withholdings to account for that overall tax obligation. So we are going to do tax projections, and we'll talk about the S Corp calendar really quick at the end of all this. But really fast, I'll say that we do a tax projection with your tax return. So if we're doing your individual return, let's say in March or April of 2020 for the 2019 tax year, we're going to project your 2020 income based on 2019 data. That's all we got.
Right.
And then we're going to update that TPW, that's our little internal lingo, tax projection worksheet. We love our TLAs here at Watson CPA Group. In fact, we've actually cooked down Watson CPA Group to a TLA, WCG, which is on Amanda's shirt right now. So anyway, we're going to take our tax projection worksheets, our TPWs, and we're going to update those again in Q3 for our small business owners. A lot of business owners have pretty consistent income. So those aren't really going to change a whole lot in Q3. But what are some examples of some pretty lumpy and bumpy income producers?
Real estate.
Yeah, real estate comes to mind.
That's the first thing that comes to my mind, too. What else?
Insurance agents sometimes.
Maybe insurance agents.
Yeah.
Financial advisors might have some lumpy income or varying income from year to year.
Landscapers. Yep.
Yeah. People that maybe rely on some sort of seasonality, right. So anyway, if you have that lumpy income or maybe even unpredictable income, then Q3 is a great time. Let's say right now, I mean, we're at the end of Q3, it's September 27th, but let's say in August, you're like, hey, I'm going to make X, and maybe that was dramatically different than last year. Well, great. Let's go ahead and update those tax projections so we can, again, continue to land on tax neutrality. So we look at it again in Q3, update the household income,
right.
Do those mock tax returns once again, recompute tax obligations, and then have a conversation with our shareholders and say, hey, here's your new income tax obligation. How do you want to handle, So, and then we do that again in Q4 in November, Thanksgiving. So after we watch the Cowboys lose yet again, we attend to Q4 projections, and we only do those though if there's more than a 10% change in income.
Right.
Well, what I do want to caution the viewers and listeners is when we do mock tax returns, yes, they're as accurate as they can be, but they're also as accurate as they need to be.
Right.
So we're not filing tax returns. We're just getting close to tax neutrality. We don't need to be perfect by the penny on those things. Now, if you say you made 100,000 and you actually make 150, that's different. If you tell us you make 100,000, end up making 101,000, that's noise. Okay. So we kind of have a materiality threshold of 10% change in income for a Q4 adjustment as well. So, all right. So that's tax projections and all the planning stuff.
Right.
Let's talk about our unlimited consultation, our PBR component. Joey, just kind of tee that up for all of us. Tell us about the unlimited consultation and the periodic business reviews.
Yeah, so the unlimited consultation is huge. It comes with all of our subscription packages. And
you mentioned that before. Can you just, that's a term of art to us.
Right.
Not people don't understand what a subscription package is.
Oh, of course. So we have 3 different subscription packages, right? We've got the Aspen, the Vail, and the Breck. And the Aspen is, we'll take care of everything for you, handle your payroll filings, issue you a W-2, and then we prepare the 1120S, which is the S Corp return, and we also prepare your individual 1040, along with some tax deduction optimizations, first industry research reports, reasonable salary calculations, kind of the whole 9 yards. And then the Vail, that's if you want to do your own 1040. Yep. So, maybe you still remember a few accounting classes. You want to...
You know what? I'll interrupt you real quick. The people that we see who do their own 1040s, even though we're handling everything else, those who do their own individual return, they seem to have a lot of other things going on. Like they have like 20 rentals.
Right.
And they're like, look, I'm already dialed in. I got TurboTax all fired up. It's got all the assets listed, blah, blah, blah. And that's great. We don't have to do everything,
Yeah, we don't mind.
And if you got it figured out, perfect. That's awesome. And to continue on, so I interrupted you. So that's the Vail package.
Right.
And then I think Breck is just you do your own payroll.
Correct.
And we do the corporate and the individual tax return.
But we'll still give you the calculations.
Correct.
Yeah.
And that's a great distinction. Thanks, Amanda. So if you choose to do your own payroll, first of all, the Watson CPA Group, we're cool in the gang on that.
Oh yeah.
we make very little money on payroll, which is fine. It's like milk in the back of the grocery store. No money to be made, but you're passing Pop-Tarts and Wheat Thins on the way over there, and of course you come out with a bag full of groceries that you didn't expect. So same thing here. We payroll's like our milk, and the corporate tax return is like Pop-Tarts, and so anyway, we will help you to the extent that we'll give you those withholding numbers on your payroll. So if you're doing payroll on your own with Gusto, Intuit, other providers,
Paychex,
ADP, Paychex, thanks, we will say, hey, that's great. You need to withhold X amount of dollars. So make sure by the time you get to December 31st, you've got these numbers on your pay stub and eventually your W-2. So if you're on what we call our business services subscription with the Aspen, Vail, and Breck packages, we used to have a Keystone package, but that fell off. Now we just do it the hoity-toities.
Just the 3.
Yeah, in Aspen, Vail, and Breck.
There were 3.
We're going to give you unlimited consultation, and along those things, we're also going to give you the PBRs. So, Joey or Joseph, you mentioned what are some of the common things people want to talk about in the unlimited consultations?
So some of the most common things, what can they deduct? What expenses qualify? One of the big ones is, I'm going to buy a car. Should I put it in my name? Should I put it in the business's name? I want to run health insurance. Can I have an HSA? Lots of those things.
The car thing, let's talk about that for a second. Yeah, that's probably one of the most common questions.
Yeah.
Should I buy a car? And if I do, should I buy it in my business? We have a whole auto decision tree video that's available on our website. I'm not sure we have enough material for a whole podcast, but it'll certainly be worked into a future one for business tax deductions for sure. But yeah, those are the common ones that I would also agree with. We also have a lot of people who just want to talk about various planning things. Hey, I got my child going off to college. I got, my wife's going to quit her job, or my spouse is going to do something different. How does that affect us? Hey, we're thinking about selling a rental. Okay. So it's not just about your business. It truly is comprehensive and unlimited. I mean, if you want to talk and about how the Packers didn't really do very well last night against the Eagles.
Sometimes you have to.
I'll begrudgingly have that conversation. I got my own opinions on why they didn't win.
Yeah, I don't know if you could take that call, Jason.
Yeah, it's too soon. Yeah. No, so we can talk about anything. And moving on to the PBRs, the PBRs are the periodic business reviews are a little bit more structured. Unlimited consultation is sort of initiated by the client. Like, hey, I got this thought. I want to talk to you. PBRs, we would like to initiate those as much as we can and say, hey, it is time to talk to us. And we try to do those 2-3 times a year. What are the two big objectives on those, Amanda? Do you know what they are?
So one is to answer any questions that the clients have.
Right.
And the second is to get accurate tax projections.
Right. Exactly. Yeah, no, that's exactly it. So why do we need accurate tax projections?
Well, so that we can accurately project how much we need to withhold.
Right. So we
It
can land that
changes.
tax neutrality. Exactly. Yeah. So exactly. So the biggest thing for PBRs is two objectives: answer all the questions you might have, and to make sure that the income that we think you're going to make is truly the income that you're going to make. Okay. And we do have a PBR agenda that is available on our website. And some of the big items, we have two versions. We have the shorty version and the long version. On the shorty version, when we talk to people, we want to make sure that we just kind of reconfirm if they've made any estimated tax payments.
Yes.
If they needed to. We typically like to do all that through payroll, so you don't have to mail separate checks or go online and do all that nonsense. So we want to confirm that, because we often tell people, hey, you need to send in XYZ, and they get a little busy and forget. So we want to confirm that. We also, like you said, Amanda, we want to confirm the net business income after expenses. So many business owners will say, hey, I make gross 500 grand. You're like, okay, that's great, but
Congrats.
we don't work in gross income land. We don't even work in gross profit land. We work in net income after expenses. I mean, if you gross 500,000 but have 100,000 or 400,000 in expenses, you really are $100,000 business in terms of a tax projection. Okay. We also want to talk about accountable plan reimbursements. That's a big deal. Joseph, you did a whole video on this.
Nice.
Okay. Tell me about the accountable plan and the common items that you find on that.
So the accountable plan reimbursements are typically seen as taxable income. So we, insert the accountable plan to get away from that. And the common items on there are going to be, home office, mileage, cell phone and internet. And we also have a portion at the bottom for out of pocket. So whoopsies, so let's say you're at Staples buying school supplies for your kids and you needed some office paper. Okay, use your personal card. So put it on the accountable plan and have the business reimburse you for it.
Good. And kind of expand on that a little bit is that the IRS views any money that comes to you, even reimbursements, to be taxable income unless you can demonstrate otherwise, and that's what the accountable plan does. So if you don't reimburse through the like under the umbrella, if you will, of an accountable plan, the IRS would consider that income taxable income. So reimbursements by definition are not taxable income, so we want to handle them correctly. So, and the big ones are home offices. Big ones are mileage in your car. Should the car be owned as an individual and you use it occasionally for business?
Mixed use.
And then, mixed use, exactly. And then business use of cell phone and internet. And the big thing is with those mixed use items, as Amanda said, we want the taxpayer, the client, to pay for them individually.
Right.
Okay. And then get reimbursed by the business for the business use portion. If we flip that around, it gets messy, right? If we have the company paying 100% of that cell phone, and we all know a cell phone cannot be 100% unless you have two cell phones, right? Now we have to take the other chunk that's personal use and impute income to the business owner. So we typically tell folks to, hey, let's go ahead and have those personal or those mixed use items paid for personally and then reimbursed by the business. So then we also want to ask about health insurance, okay, HSA and HRA stuff. And then what is your planned IRA or 401k contributions? Okay, because that's going to reduce your taxable income. If someone says, hey, I'm going to make $100,000 net income, and we're thinking $100,000 all day long, and all of a sudden they come in and go, oh, I just got done contributing XYZ to my 401k or my IRA, that's going to alter the tax projections. Now, sure,
Right.
it's going to make the refund go up, but it's not accurate in the sense that we would rather not have a big refund. We'd rather dial that refund in tighter, and you can take more cash out of the business throughout the year. So we want to know what your planned IRA and 401k contributions are. And sometimes that's difficult. People don't always determine that until maybe tax time. Yeah, whatever, no big deal. And we also want to talk about other income sources. So that's the periodic business review shorty version.
Yes.
Is to look at estimated tax payments paid so far. We want to look at your net business income after expenses, all your accountable plan reimbursements. Because again, the same thing there, if we don't know that you're going to have $20,000 in accountable plan reimbursements, and we're thinking you're making $100,000 and we're projecting taxes based on $100,000, and then you roll up with an $80,000 net business income because you reimburse yourself $20,000 for accountable plan expenses, it's going to throw off our tax projections. Now, again, all that's going to do is make your refund go up, but why not dial that in tighter?
Just keep your money.
Keep your money, people. Exactly. And then we want to talk about health insurance, because that kind of factors into some of the reasonable salary computations and all that. And then IRA, 401k contributions, and of course, other income sources. And we also, not only do we have to look at other income sources, we have to look at what they're withholding, right? Because you have a spouse who makes a W-2 or has a W-2 job, and they're withholding, we need to work that into the withholding numbers as well. So that's our periodic business review. If we go to the robust version.
Not long, it's robust.
Yeah, so not the shorty, not even long, it's robust. We talk about all kinds of other things. We talk about entity and ownership considerations with you as a business owner. Do you plan to sell? Do you want to bring in more partners and complicate the heck out of your life?
Right.
Do you want to make mom or dad a silent member? You know, all those things we talk about. We want to review your financial statements and just kind of see if there's anything wonky in there. Too often we see homegrown bookkeeping turn into a tax bill because they are deducting things that they shouldn't be deducting, and they're giving us a number that isn't accurate. You know, you say I make $100,000, and after we determine that you can't deduct some of the things that you thought you could, you make $150,000. That's going to tilt the amount of tax due. So, business deductions. We did a video on this just recently about commuting expenses, country club dues, education, per diem. So we kind of run through that. Accountable plan stuff. We also look at end of year tax moves. You know, what are some of the things that you've heard me or others, you know, talk about from an end of year tax move perspective?
Oh boy, on the spot.
On the spot,
I
yeah.
know. Joey's gonna have to help me.
All right, looking at me. Well, obviously the big one is people want to reduce their taxable income at the end of the year, so they'll call us up and be like, again with the car, they'll be like, should I buy a car? And we'll answer, do you need a car? And then we'll kind of go through the process we have for determining whether the business should own it or they should own it personally. But really the big thing that we have to think about for end of year tax moves is it going to be a better deduction this year, or is it going to be a better deduction next year?
Right.
So we kind of have to play with that a little bit to see, because is this year unusually high for income for you? Or are you going to do better next year? Because we don't want to spend $80,000 on a BMW this year if next year you're going to double your income.
Right. Yeah, you want to match the big deduction with the big income, right? Makes sense. Yeah. Sorry for putting you on the spot, Amanda.
That's okay. Thanks for jumping in, Joey.
No problem.
I know.
We're also, with the PBRs, we commonly are helping people out with Roth versus IRA discussions. Now, we have some financial advisors, certified financial planners that work here at the Watson CPA Group. I used to be a financial advisor, so I can talk this stuff from a roundabout way, but we can't give investment advice.
Right.
You know, we can give tax advice. And the question is IRA versus Roth. Well, that's really a matter of your current marginal tax rate versus your future marginal tax rate during retirement. So some of those are typically held or should be done with your financial advisor. But we do talk about other goals, like do you want to buy a rental? Do you want to buy a second home? Do you want to buy another business? Those are common things we get all the time as well. We do discuss with folks like their 401k versus a SEP IRA, and we have a video on that as well, how to maximize your retirement using a SEP IRA versus a 401k. So those are all common PBR items that we talk about, and our PBR agenda is 10 pages long. For those of you who are seeing me on video flipping through the pages, there's a ton of it that we go over. And what this PBR and the questions are really designed to do is we don't cover all this in one meeting.
No.
You wouldn't want to as a client because it'd take 5 hours and you'd be bored or at least tired of talking. But it does help just create a memory jog. Hey, I want to talk to somebody about this. I have been thinking about that. I have been staying awake at night thinking about this. Let's talk about risk mitigation and estate stuff. Again, generally speaking, we're not attorneys, but we talk about them in roundabout ways. Some of this is designed to poke and prod during the PBR to uncover the problem areas that might need either further attention by us or further attention from another trusted advisor, whether that's a financial advisor, an attorney, something along those lines. So that's one of the benefits of our business services packages, our subscriptions, as we call them here, is that all this stuff is unlimited. Now, people say, Amanda,
is it really unlimited?
Is it really unlimited? Is there a limit?
So yes and no. We value your time.
It's probably a theoretical limit. There's only 365 days.
It's Joey's favorite word. Depends. We value your time and we value our time, and we expect that you also value your time. If for some reason we were ever get to where we're like, hey, we've had this conversation 4 times. I mean, we'll have it again, but it's on us to let you know.
Yep. No, I tell people that all the time. It truly is unlimited. If we feel like you are reaching this quasi-theoretical limit to the word unlimited, well, then Jason's not truly unlimited. Well, okay. But if we feel like maybe, you've reached this spot where we have to have a conversation, that's on us, right? To say, hey, we need to maybe re-look at the terms of our contract. It's not even a contract. It's a proposal that doesn't really bind anybody except for us. Really, it's more like a big engagement letter. But I can't think of ever having that conversation with anybody. We understand that typically in the beginning of any relationship, you're going to have a lot of questions and all that stuff. And we are here for the long term. I mean, we understand that, you might have a question every other week in the first year. Well, we understand, or we hope, I guess, that in the years to come, that goes down to once a month or once a quarter. At the same time, we don't care that people email us and call us, because they do, and it's great.
And they should.
We can't unring the bell, right? We can't put, one of my favorite phrases, we can't put toothpaste back in the tube. So if you start making decisions without consulting with us, some of those we can't walk back. Some of those we can. But it's probably better off to not operate in crisis mode. We should probably all operate in planning mode, which means take advantage of your unlimited consultation and call your friends at the Watson CPA Group. And we don't like that nickel and dime billing.
No.
We probably take more of a win some, lose some approach to our engagements. Some engagements we do really well on, the client's super organized. Some engagements we have to work a little harder on. We're okay with that. We're all okay with that.
We'd rather you call us with a question and then us say, hey, that's really more of a financial advisor question or an attorney question. We'd rather you ask us than not ask.
Absolutely. And we have referrals for that stuff as well. And sometimes we can help you tee up the question or tee up the concern that you have and couch it correctly with that other professional. Because some people will describe what they're trying to think or what they perceive as a concern, and maybe we kind of reposition them and say, you have a concern, but it really is this and not that. So that's great. Let's, we only have a few minutes left. Let's kind of run through, Amanda. This is easy for you, softball.
Softball. I love those.
Talk a little bit about business tax returns and the due dates. And we'll also kind of jump into the process and extensions, but just kind of run through some of that stuff.
Sure. So your 1065 and your 1120S, which is your partnership tax return, and your S Corp tax return, those are typically due March 15th or the next business day if that happens to be on a holiday or a weekend. And the reason those are due earlier is because both of those returns generate K-1s, which flow through to your personal tax return. The 1120, which is your C Corp tax return, that's due April 15th, or again, depending on holidays, weekends, all of that.
Yep. Okay. And for the Watson CPA Group to do your tax returns, to prepare and file them, what's our general document cutoff date?
So 3 weeks before the due date.
About 3 weeks.
Mm-hmm.
Yep, exactly. It just gives us time. Nothing good happens when we rush.
No,
right?
we'd rather file a return late, extend you, than rush a return through and find out later that it wasn't right.
Yep. Yeah, it's just not healthy for anybody, including us. So tell me about extensions a little bit,
Sure.
especially when it comes to business returns.
So if you extend your business, those two businesses, the 1065 and the 1120S, partnership and S Corp, then we're also going to recommend that we extend your personal. Well, we are going to extend your personal. And again, that's because you need that K-1.
Right.
So we can't file your personal tax return with on time if we've extended the business. To file an extension, and there's another video on this that I did this morning.
Nice.
Yeah, so tune into that. But to file that extension, we need your written authorization. That's not our rule. That's an IRS rule. But we'll go ahead and extend it for you. That does not extend your time to pay. So if your business has a franchise tax or something that's due, we'll let you know, and that will still be due on the original due date of the return.
Right. That's a big deal. A lot of people forget this. They're like, hey, it's a pass-through entity, right? A 1065 a partnership return, 1120S S Corp return are pass-through entities. And by definition, that is suggesting that the income tax obligation is being passed through to either the partners or the shareholders. That's entirely true. But there might be a franchise tax, which is not an income tax.
Right.
And there might be some other insidious pleasure to do business in our taxing jurisdiction tax that would be due March 15th.
Right.
So a lot of people get comfortable with like, oh, I'll just file an extension for my pass-through entity. And for 90% of them, that's totally fine. There's going to be 10%, maybe even a little higher, where we have to then do a projection, an estimated tax projection for that entity so it can file its franchise tax or whatever tax that might be due to the state. Nothing will be due to the IRS ever. In S Corp land or in partnership land, but for states possibly.
Yes.
And yes, at Watson CPA Group, when we extend the business return, we would like to also extend the 1040 with your permission, because we're not going to prepare the business return until May or June. Now, we, unlike other CPA firms, we are not ones to just kick the can down the road till September.
Absolutely not.
We when we extend your business return, on May 1, we start hounding you in a kind and gentle way. But we would like to get your returns done as fast as you can get us the data. I think unlike a lot of CPA firms, we continue to be busy in May, June, July, just because we are getting on top of folks saying, hey, can you give us your data? We need your data. We want to get you in and get you out. I think that's all the time we have. We did discuss in great detail tax projections, why that's critical, tax neutrality, looking at the household income. So often we do have to chase down that spousal income,
right.
and we're We're just trying to put you on solid tax neutral ground, which is why we kind of need all that stuff. We discussed our PBRs, our periodic business reviews. We discussed our unlimited consultation and the benefits of all that stuff.
Yes.
And we also briefly touched on the tax return due dates, the process, and how if you do an extension, it's not your extension to pay, just an extension to file. I want to also add on to that. If we do then extend the 1040 tax return, we need to do a quickie tax projection on that to make sure a payment is not due.
Right.
If you have been using us throughout the year to help you with those tax projections and the planning and all that, well, then that's already been done. And that's one of the benefits of periodic business reviews, unlimited consultation, tax projections, and planning. If we do that correctly throughout the year, then the tax return is just a natural progression. It just follows right behind that. I feel like far too often CPA firms don't do anything, and then it's a mad dash in December to try to figure out someone's tax obligation.
Yep, big
or it's a
scramble.
mad dash March 14th to figure out someone's tax obligation. That's crazy. It doesn't do us any good, the client any good, and all that stuff. We'd rather, again, operate in planning mode than crisis mode. And this is, again, shameless self-promotion, but that's what you get with the Watson CPA Group. That is all the time we have. Thank you, everybody, for listening in and watching. Jason Watson, Watson CPA Group, Amanda Rowles, and Joseph Bassett. Visit us on the web, WCGInc.com. The podcasts are available on iTunes and Spotify and other quality providers, I guess. You can also download our book. And also, feel free to give us a call or email us. There'll be links available on our website for that as well. Love to chat with you. Love to see how we can help. So thank you, everybody.